at least we haven't seen mass job losses. And I think that's kind of an important part for the housing market.
Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 10th of August 2026. I'm Head of Research, Nick Goodall, and today I'm joined as per usual by our Chief Economist, Kelvin Davidson. Kelvin, it's all about the labour market this week, so let's get straight into it. Not a great headline figure for the unemployment rate itself, but equally maybe not quite as bad as it sounds. Is that a fair initial assessment, mate?
Yeah, I think so. I mean, if there's such a thing as a good rise in unemployment, this was sort of probably it, I suppose, or at least in the unemployment rate. We saw the unemployment rate go up from 5.3% in Q1 to 5.6% in Q2. There may have been a revision to that Q1 number potentially. I think maybe it was revised up 0.1, but either way, yeah, quite a big lift in the unemployment rate. Now, when I say a good rise in the unemployment rate, I mean no rise in the unemployment rate is really good. So that's good in air quotes. But the reason I say that is because it came from just a bigger labour force. So it wasn't job losses. In fact, employment went up in Q2, but it's just that so labour demand went up effectively. So more people were actually working. But just on the other side of the equation, there was also a lot more people available for work. So, our overall population or working age population went up, and a higher proportion of those people available or within the working age population, a higher proportion of those actually made themselves available for work. So labour demand went up. Yeah, for sure. That's pretty encouraging given everything that's been going on. There were actually more people in employment, but labour supply went up even faster. So you saw that overall proportion of unemployed go up. So it's never great. 5.6% unemployment rate, I think, was the highest 10 or 11 years. So it's, we haven't seen this for a while, but if you can say it was good, well, this is about as good as it gets in terms of higher unemployment. So yeah, I think that was sort of the overall conclusion for me. I mean, there's other measures around that in terms of like underutilization. So where people are perhaps wanting more hours, they might be part-time, want to go full-time, that sort of thing. That rate went up. So that's probably not quite so encouraging. Wage growth was still pretty subdued. So, it's not like this is a great number, but at least we haven't seen mass job losses. And I think that's kind of an important part for the housing market in particular, because we're not seeing repayment problems really, or mortgagee sales or anything like that. And I think partly that's to do with the fact that people have stayed in work. Generally people are able to keep paying that mortgage because they've still got an income generally. So that's had implications for the housing market. And I guess servicing has played a role there as well. The testing has perhaps weeded out some potentially dodgy loans before they were even over the starting line. So that's probably helped with some of those subsequent potential repayment problems. But so I mean the headline numbers, that's it wasn't a great number for sure in terms of the labour market, but it's at least employment isn't falling. So take a wee silver lining from that.
Yeah, I think it's definitely easy to take the start however you want, right? If you want this to be evidence of a difficult labour market and a struggling economy, you can certainly find the data to back that up. Equally, if you want to look for something that's more promising in the data, you can find that too. And I think we will do sort of both, I suppose, in many ways, because as you said, from a property market perspective, if you don't want housing values to fall away because, people losing their job and not being able to pay their mortgage, which I think everyone can agree we don't want to see, then I think this shows that, there's less likelihood of something like that occurring. In terms of health of the economy, I mean, it's what would you call it, a loose labour market. There are people looking for work. As you said, the wage growth is relatively low because those workers are mostly happy to have a job and not really have the power to be able to say, I want more money. And so, that's again, not a great sign of a strong labour market. Equally, if you want to flip that around and say, well, we are looking for evidence of second round inflation, and if second round inflation, including wage growth, is not that strong, then, maybe there's less need to fight against a high inflation because that wage inflation isn't going to push through to higher inflation itself later on once we get past whatever the spike is that we're seeing from the disruption in the Middle East and high petrol prices which are flowing through the broader economy. So, you could probably put an argument there that also says, the signs of second round inflation are low, so you don't need to keep hammering the OCR higher to get hold of inflation to bring that down, because if it's just short-term volatility from petrol prices, then maybe there's no concern on the other side of that too. So yeah, it's an interesting one, and I think this is partly why there is such a strong debate at the moment as to what will and should happen with the official cash rate, is because the data can be seen in many different lights, and so it makes it an intriguing conversation. Um, we can touch on regional stuff too. I did see, as per usual, all the different economists put out their takes on this, and I think there's probably two major things I took from the different publications that went out there. Partly, I think, for me, it's the forecast as well of where this unemployment rate's likely to sit, and it's likely to stay similar levels. I think many had unemployment probably peaking in Q3 this year, and that still seems the case, though it might peak at the same level of Q2, so it might sort of have peaked last quarter, stay at a similar level now before it maybe starts to decline, but only get better slightly in the coming quarters. And obviously we won't get Reserve Bank's updated forecast until next month when they have their monetary policy review out or statement out along with their forecast, but they did have their forecast at 5.4% and staying there for a good 3 or 4 quarters. So if that's true, then that might stay, at similar levels, 5.6% for the next few quarters. So I think that's partly what I was looking at, was what does the unemployment forecast look like from those economists. The other one was, there was a lot of chat about the split regionally. In particular, Kiwibank put out a chart looking at the different regions' unemployment level. And it really is a tale of, I think they even talked about, the tale of two islands. The North Island having an unemployment rate at 6%, the South Island down at 3.7%. So quite a big difference there. And then when you go even more regionally, of course, Otago, Canterbury, 3.6% themselves. So, not too bad an unemployment rate down south. Whereas when you come to the Northland in particular stuck out, 8.8% unemployment rate. Auckland, next worst at 6.5%. So quite a high unemployment rate in Auckland. Wellington's in the middle there somewhere, 4.9%. So maybe not quite as bad here in Wellington that many people might have expected. Maybe that's a sign of, not many people, if you're looking for a job, are coming to Wellington anymore. We know plenty of people would have, been aware of the difficulties in the government area and the broader economy here in Wellington. So maybe they're not moving here and looking for jobs. They're going to Auckland or they're going to Christchurch and getting that job. But that might be something that's keeping that number down, but certainly doesn't look too bad. And certainly from all the stories of Wellington's death, 4.9% doesn't sound too bad on the face of it either. But other parts of the North Island, you're still seeing up around that 5.8, 5.6 for Hawke's Bay, for the Waikato region. There's definitely that divide there. And again, I suppose it does relate in many ways, not all of them, because Waikato obviously and Bay of Plenty will be agricultural economies as well, or partly supporting agriculture. So it's not all about just this agricultural divide, but certainly down south when you see the Canterbury and Otago down quite low is obviously a reflection of those strong agricultural industries, which we've spoken about a lot of the recent times as well. So yeah, so it's a bit of a circular rant, I suppose, there, with not too much summarization, except to say that, yeah, I guess, we need to, I don't know where you sit on what influence could or should this have over the Reserve Bank when they come to make their decision, and what's that, less than 4 weeks now, 2nd of September, about what's next for the OCR. Do they need to continue to get it to neutral, or is there enough in here that says, the wage inflation's not there, 2% or so, well below the overall inflation level of 4%, that says, look, we're unlikely to see the second round, so, you can tie-ho a little bit and don't need to worry about the short-term volatility and inflation rates. Where do you sit on that?
Yeah, well, I mean, like you said, you could find arguments in these figures for both positions, really. I think. I mean, I just quickly on that Wellington unemployment number. I was going to say. I mean, I think one thing we've been talking about is that the impact, say, on the housing market isn't. I mean, it can be about job losses, obviously, the direct effect, but also it can be this sort of indirect spillover impact where even if there isn't mass job losses, people just feel a bit more uncertain and might not be so strong in their job security might not be as high. So maybe that's a good example there of the Wellington number. People would probably assume that the Wellington unemployment rate was quite a bit higher, given what we hear and also how the housing market's been performing. But I think it's probably a good illustration that you don't necessarily need direct job losses to restrain a housing market. I mean, there's other things going on too, but it's probably the labour market impact in Wellington has been more about those spillover indirect things where people perhaps don't feel quite as secure, they're not quite spending as much, even if they've got their job, they've still got other, so their confidence is down. Maybe that's sort of part of it. So
Nervousness.
Yeah, that's right. Yeah, so that's probably a good illustration there. But I mean, in terms of the labour market impact on the Reserve Bank, I kind of, you could see arguments both ways. I still lean towards no real impact. That they'll probably stick on the path they thought they were going to be on anyway. I mean, yep, wage growth is subdued. It doesn't necessarily hint at any strong second round inflation impacts just yet. But I guess just because it's there yet doesn't necessarily mean it won't be. And the Iran thing's lingering on, and fuel prices are still high, and I think probably the Reserve Bank's still really alert to those risks. It's sort of the least regrets option that they still might be thinking about. That's the phrase that keeps coming into my mind. Is okay. Yeah, you might not necessarily see second round inflation yet, but where are the risks? The longer Iran goes on, that's probably where the risks are that you do see it emerging at some time. So maybe, try and get ahead of the curve. Monetary policy reacts with a lag. So, stick to the path, at least get that OCR back to neutral. And, that's possibly the sort of least regrets option. But yeah, you can definitely see arguments either way. And, it'll be interesting to see what comes out on the 2nd of September. We get the full forecasts and, the full media statement and conference and all of that. For now, I probably still lean towards a rise at that next meeting on 2nd of September. But I mean, yeah, anything could happen.
Yeah, for what it's worth, I think I agree in terms of what they will likely do. I think your take on the way they'll be reading this is probably bang on. I'm just not so sure that the economy is as strong as they think. The bounce back in the economy is going to come as fast as they think. And I think anyone that's seen me speak recently, I was in Nelson last week. I still have this doubt as to, the economic forecasts that are out there for where this growth is going to come from. And if there's not that much economic growth, I don't think there's much upward pressure on inflation. And yeah, still absolutely determined by how long this disruption goes for. And if the Strait of Hormuz is closed longer and there's no peace deal on things, then of course I get it that this short-term spike in costs isn't going to go away anytime soon. But if we do assume that, this cannot go on forever, that there has to be a resolution at some stage, and the hope and preference is absolutely sooner rather than later. And the signs were that once the Strait of Hormuz was back open and petrol prices came down off the back of that, that we can get back to some sort of normality, but inflation will actually come down quite quickly. So I think that's probably it for me. It's like the read on the economy and the labour market. If you're confident in maybe some optimistic forecasts, then totally agree that path back to some sort of level of neutral makes sense. If you're not so much confident in that economic recovery and that labour market strength, which I do think is showing weakness, even though, we saw some growth in jobs, I just wonder if that shows that, you don't have to fight this inflation quite as hard as their current path shows they're going to do. So, look, it will continue to rage on in terms of a debate. And we don't have any official tier one statistic releases between now and the next decision. I know we'll have things like filled jobs, and we'll get the Kiwi GDP nowcast for out as well. So we'll get those sort of faster reads of the economy and jobs and all that sort of stuff. The selected price indices, so we're getting a feel for what's happening with inflation as well. But we don't really get any official sources of data between now and then. The GDP data for Q2 will still not come out until late September. So, they're not going to have any of those official sources before they make the next decision. So, this is the kind of last big one, aside from those other releases, which aren't quite as, I don't know what you call them, official, tier one, whatever. So you'd think that, their mind will mostly be made up unless those other data releases are hugely surprising and we see something that no one was expecting. And so, that's why I sort of think that from now on we can probably get a pretty good feel for what their decision is going to be and what their path looks like. But still, not confident to call it just yet. We've still got a few weeks, but that's probably where I lean anyway. All good, mate. I mean, the next sort of release I want to talk about anyway, we'll probably lean into a lot of the conversation we've already had. So I don't know if you want to summarise anything else on labour market and economy before we move into this, but I'll pass to you anyway. Obviously, last week you wrote a Pulse article. It wasn't using Cotality data, but it was looking in more detail at the Reserve Bank lending data itself. You sort of wrote an article, good little listicle, I suppose they call them, on the 10 things to know about that Reserve Bank lending data. I've got a sort of top 3 things that I was going to cover off, but maybe I'll pass to you to summarise anything from the prior chat, and maybe you can lead into, I don't know, what you found most interesting, maybe what the media picked up on the most from that data, and I'll pick up anything else that jumps to mind after you give us that kind of overlay from the start.
Yeah.
Yeah, so I mean, yeah, listicle, as you say, top 10, 10 things to know about mortgage lending. Everybody loves a list. So I put one of those out. It's looking at the sort of what's going on in the mortgage market at the moment, some things that I find interesting, and hopefully others do as well. I mean, probably the thing which the overall story from mortgage lending at the moment is that growth has slowed down. Um, Probably that wasn't really the thrust of the article, but that's what sort of media picked up on. And I kind of had to say, well, yeah, it's sort of inevitable. And we know that sales volumes have slowed down, so it goes hand in hand with mortgage lending. But also, there's been a period of growth, so the actual dollar value of lending is a lot higher than it used to be. So sort of mathematically, of course, growth will slow down at some stage. So it's sort of that wasn't really the thrust of it, but that's kind of what people picked up on. So that's fine. That is true. But yeah, for me, I guess, I mean, behind that overall slowdown, investors have cooled a bit, which we're seeing in bioclassification too, our own figures. So that was, a useful cross check there. Some signs that they're hitting up against the LVR buffers. So, the Reserve Bank increased the speed limit for high LVR lending for investors tail end of last year. And, not by much, but it's interesting, investors have pushed up, and it looks like probably pushing up towards that buffer already. So, that could be a reason behind the overall slowdown for them. But I think there's bigger challenges for investors at the moment, which we've talked about before. First home buyers still really strong. Still, 50 or 60% of first home buyers are getting in without 20% deposit. So, they're still accessing that low deposit finance pretty strongly. And yeah, but I suppose a couple of other things which might not always get a lot of coverage. The non-performing loans part of these figures are still really low. So the non-performing loan ratio on banks' books is still low, and I think that's that's partly what we've talked about. Employment has stayed pretty strong. So the people with the mortgages will also be the people with the jobs. Not so great for somebody coming into the labour force, of course, to find a job at the moment, but in terms of the housing market, they probably don't have the mortgages already. So, the people with the mortgages, people trying to service that debt, will have largely kept their existing jobs. So, that's helping loan repayment problems stay relatively low, and that servicing thing as well. Servicing tests within the banking industry have probably got stronger over time. So that's perhaps weeded out some of those risky loans before they even got going. So I think that's part of it. We're still seeing a decent level of switching, or refi, bank switching, changing lenders has come down from a crazy peak at the tail end of last year, but still reasonably significant. The structure of existing debt's still fairly short. We've still got something like sort of 10% of debt on floating rate and sort of 30-ish% fixed, but due to reprice in the next 6 months. So you've got a good chunk of people that still have flexibility, not as much as there used to be, but still a good chunk there. So, they can chase the cash back at another lender without too much in the way of costs and break fees, that sort of thing. So yeah, still a bit of switching going on. When those people do switch, or when people take out a new loan, there's also this tendency to fix longer now. So for a while, everyone was fixing short or floating. Now we've seen quite a push out towards, say, the 2-year fixed rate. It's got quite popular. So it makes sense as interest rates rise. You kind of take a bit of insurance against that and fix for longer now to try and potentially beat those rate rises later. So yeah, those were kind of, I don't know how many points that was, 3 or 4 things that jumped out. I think yeah, the one that probably doesn't get quite as much coverage as some of the others is probably that non-performing loan one, which is still pretty low. And really, given the weakness of the economy that we've had for 2 or 3 years now, it's probably it's pretty good result, because in the past we might have seen that non-performing loan number a lot higher, mortgagee sales a lot higher. So to have that still pretty controlled, I think is showing that credit standards have risen over time, and also helps that we haven't had big job losses either. So yeah, those are my main things.
Yeah, I think it's a good one because, as you say, it is so much intertwined with the economy and labour market as well. And it does show that, yeah, because we've been through, what's all the headlines been saying, right? The worst housing downturn in 40, 45 years. And yet there hasn't been, big problems or mass falls after the initial fall. And because that initial fall came off a massive rise, it still doesn't quite feel as bad as maybe some of those other ones that people would have lived through, whether that's the GFC or ones, prior to that, late 90s, late 80s. And so I think this is a big reason why, because we haven't actually had things be that difficult, because we've had improved standards of lending, because those people haven't actually lost their job. Yep, they might feel a bit trapped in their property because it's worth less than what they paid for if they bought it at the peak of the market. But for those that can manage to hold on and haven't had a massive change in their life, either someone losing their job or going through a divorce or something, where you're then forced to sell the property to divide the asset up or whatever. If you haven't had those significant changes, then you try and ride it out, and yes, hope for some growth to come back in the future, or you continue to pay down the debt, increase your equity, or reduce the negative equity if you're in that position over time. And I think also that goes back to some of the chat about the unemployment figures, right? We know we talked about regional stuff, but there's also some pretty decent split of unemployment by demographics and age bracket. And I know that youth unemployment's really high, which is not great for a broader economy. If you're putting a pure property lens on it, those people don't own property. And so, it's meaning that we're not seeing all these people have to get out of their house, which would likely see greater falls in prices. And so, but that probably does flow through to the rental market, because if you're unemployed, what are you likely to do? You're likely to stay at home with your parents longer. So there's less demand for rental property. And that again means there's less flow through to that cash flow for those investors. So I think there's lots of little links here, which are important for the housing market. The other one that I pulled out was just your tracking of interest only lending. And this has remained relatively under control, right? So again, when you talk about the bad provisions or mortgage arrears that have stayed quite low, so is interest-only lending. And I remember a few years ago, we were looking at this going, if we see lots of people restructuring their mortgage to interest-only, it means they must have a cash flow problem. They're going to do it for a short period of time. There's talk about mortgage holidays, that type of thing, that you reduce your payments while you go through a difficult period to hopefully then come back to principal interest later on. We just haven't seen that at any time throughout this last few years, which to me says that, maybe there isn't as much of a cash flow problem as we thought, even for those investors who we know are dealing with high expenses, can't pass those expenses on through to the tenants through higher rents. They're managing to find a way to get through this without even having to restructure their mortgages as well. So, again, they're finding a way. And I think that's where there's some real good, strong detail within this data. I don't have too much else to chat about that. Your article, just really pointing out that bank switching is still really popular. It looks like nothing compared to that December 2025 peak, which obviously was crazy levels off the back of those cashbacks, but is still pretty strong. Those options are definitely out there for people that want to go out there and get the best bargain you can, and certainly whether you're going direct through a mortgage advisor or you go direct to your bank yourself, certainly worth squeezing out whatever deal you can get from them. If you're a good borrower, you've got good record, you've got a solid job, they're going to be fighting for your business, so certainly worthwhile doing that. And the other one I think is something we spoke about a few, weeks, maybe a month ago, was just the fact that those headline calculations on paper equity, the fact that housing market's worth $1.7 trillion, debt is $400 billion, mortgage debt, but acknowledging that not all that money is going to be collected on by people, but also that debt is actually highly concentrated by a third of all Kiwi out there. So it is highly concentrated there. Yes, there's a lot that people could be drawing on, people with no mortgage or very little mortgage, but that debt level is held by very few people as well. So that means that when there are changes to interest rate or regulations, that's where they can be quite impactful, because a lot of people, or a small amount of people are bearing the load of that high debt. So it's an interesting one when you look at those total figures as well. But I'll leave a link to the full article anyway for anyone who wants to go and I suppose you just read the data, because it's hard sometimes on the audio platform so to take all that detail in. So the article's on the website anyway. I'll leave a link to that and people can go and check that out as they want. But that's probably it for the property market chart. I know we've got pain and gain report this week, Kelvin. Any short preview you want to do on that, or any other wrap up of other housing and property market chat before we have a quick chat about the weekend?
No, not too much else. Pain and gains out this week. It's it won't be too many surprises in there. The market's obviously still in favour of buyers at the moment, so resellers aren't doing as well. But again, a hold period, that's the biggie. If you hold for a decent period of time, a loss is pretty unlikely. If you buy and sell within a short period of time, a loss is much more likely. So all the data, all the detail will be out later in the week.
And there's still some pockets to look at, right? Apartments in Auckland, worthwhile looking at the detail of that data too. So there's going to be some specifics that are worth paying attention to. But otherwise, like you say, hold period is the core thing. You bought at the peak of the market, and then you have to sell, or you are encouraged to sell, or you want to sell now, you're not going to be looking at a great equation, and the report certainly reflects that. But that'll do us for the property market and economic chat, Kelvin. The only thing on my mind from the weekend, obviously the All Blacks tour of South Africa, the greatest rivalry, is underway. Slightly underwhelming win against the Stormers, pockets of good stuff and some discipline issues and certainly frustration with the officials. But yeah, I suppose, they'd probably have learnt lots, and that's what they need going into the pretty incredible test series, which I know starts not this weekend, the weekend after. So you're very much looking forward to that one. I don't know if you got much of a take on that. I don't know, big news was obviously Ma'anonu being announced on the bench for the Sharks for the Wednesday morning game against the All Blacks. So that's pretty amazing. There can't be too many people that have played tests for the All Blacks and then are going to play against them. And certainly not someone of his, quality or played as many tests as he did. But yeah, how was your weekend otherwise, mate? Did you catch that game? Any NPC? What else is on your mind?
Yeah, not a huge amount. I actually went away to Hanmer for the weekend with friends. No kids, so it was just four adults, and we had a very good time. It was awesome. Yeah, amazing. Just how much extra time you have. You can just take it easy, chill out. You can yarn for an hour or two. It doesn't matter, no pressure. So that was really good. Means I didn't see the All Blacks in detail. I saw sort of 12 minutes of highlights. That was about it. But so not too much to add there. I suppose the thing for me was the Warriors. I mean, I'm a Raiders fan, so as long as the Raiders have got some sort of hope, they're my number one team. But I'm sort of now, because they're pretty much done. I'm sort of waiting for them to officially bundle out, and then I can jump on the Warriors bandwagon, as my number two team. So yeah, they were impressive. The Penrith are a very strong team, so I don't know. Could this be the year? We'll wait and see.
Yeah, I totally agree. I only saw bits of the game, but certainly saw their haka. And, the campaign's got to be on for the Warriors to do a haka. I don't know, maybe every home game instead of every game. But yeah, that was an impressive performance, particularly that first half. So shows they got it in them. And yeah, what a return for Luke Metcalf as well. So they've got some selection decisions coming up. There's no doubt about that. And he seemed pretty happy to be back out there. So man, if they can all come together for, the final series, which can't be too far away now, it's going to be a heck of a series. And maybe, just maybe, that collision course for another grand final, the third one for the Warriors. Let's hope so, mate. All good, mate. Anything else on your mind before I close us out?
No, that's it from me. Yep, all good.
All good, mate. I will up the wires. And thanks very much, as per usual, for your thoughts, for bringing the Warriors up. Great call on that one, mate. Really appreciate it. But thanks very much for listening. Please do get in touch with any questions or feedback. Always keen to hear what's going on in your world. But that'll do us for today. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.